Hi, welcome everyone. This is Brian Walsh with SoFi. Thank you very much for joining us today on another one of our weekly live streams. Today we have the opportunity to have a guest again to really go through a topic that has been coming up more and more recently with our members. So I guess we'll do some background information, some disclosure, and we'll really kind of hop into the meat of the conversation. But for all of those of you who are tuning in, if you do have questions throughout, we have some questions that we've been going through that we've been seeing for our members. But feel free to drop your questions in the comments, and we'll get to them towards the tail end. A little bit of background. My name is Brian Walsh. I lead financial planning at SoFi. So really, that just gives me the opportunity to hear what our planners are talking about with our members, just like you, on a regular basis. And that's how we come up with topics for these live streams. And I'm joined today by Matthew Bartolini, who is from State Street Global Advisors. And today we're going to be talking about ETFs, really taking a deep dive into something that gets talked about on a regular basis, whether we know it or not, whether it be just invested in ETFs through SoFi automated investing, or making a decision on your own to invest in ETFs. Really thought it'd be good to dive into some of the details. Before I pass that on over to Matthew to do a quick background and introduction, some compliance stuff, full disclosure, anything we talk about today, not considered investment advice or any advice in general. We don't know enough about you to provide advice. Look at this as education, high-level thoughts, more conversational. If you do want advice, you could schedule a complimentary call with one of our financial planners at SoFi. All right, so now that the fun stuff's out of the way, why don't we kind of transition over, Matthew, if you could just give a high-level, intro and background, and then we can get started.
Sure, thanks, and thank you everyone for watching today. Hopefully you find it educational. So my name is Matthew Bartolini. I'm the head of ETF research at State Street Global Advisors within the SPDR ETF business. At SPDR ETFs, we have over $800 billion of assets in ETF strategies, over 140 different funds covering index-based instruments like the S&P 500, as well as active strategies, ESG, thematic strategies focused on things like clean energy, as well as smart transportation. And we are offering a significant amount of insights on a daily basis through our website and blog to really help investors understand the ETF ecosystem, but also how to take advantage of it by using the instruments we have within our suite based on particular market events, whether it's the election, positive vaccine news, or just your broader outlook for 2021.
Awesome. So we have an ETF expert here. Let's just get started really with the basics. I don't know. One of those things is, I don't know if it's just me, but every now and then I'm in a meeting and there's a new acronym that gets thrown out there. And I'm like, I have zero clue what this acronym means. So I always like to break down acronyms. I guess, can you break down what does ETF stand for? And at a high level, how does an ETF work?
Yeah, well, ETFs are all about acronyms. So, we at State Street, we talk in tickers a lot. So I'll, throw out things like KRE, KBE, and those are our regional bank and banking ETFs. And always, people don't understand the tickers and the association with that, so I'd have to go back and explain it. ETF, same thing. I have a lot of friends in the software development industry, and they was asking what are exchange traded funds? And that's exactly what ETF stands for, is exchange traded funds. These are a basket of securities in a fund that can be traded on an exchange. It's very similar to a mutual fund, with the exception that mutual funds do not trade on the New York Stock Exchange or NASDAQ. ETFs do. So our S&P 500 fund, it owns every stock within the S&P 500. We issue shares to the primary market, and then that goes on and trades in the secondary market. Someone can buy and sell shares of the S&P 500 ETF on the New York Stock Exchange or NASDAQ, wherever you trade. So that's really the basic example. In terms of how do they, without getting too technical, you have two markets. You have a primary market and a secondary market, that creates a lot of benefits, really. But the sort of structural way this works is, say I'm an investor, and I really like the idea of clean energy. And so I want to buy State Street's clean energy ETF. So I go out through my SoFi account and buy shares of CNRG, which is our ETF. You buy that on the secondary market. Say you buy 5 shares of it. CNRG trades, in the neighborhood of like 20,000 shares a day. There's a decent amount of liquidity out there for it. And you're able to tap into that. So a market maker will sell you the 5 shares and you go on your way. Now, let's say everyone really likes the idea of clean energy, right? And there's only 20,000 shares available to buy or sell. But you have a lot of friends and everyone wants to buy 10,000 shares and you have 100 friends, right? So you have a lot more demand for shares of our clean energy ETF. So you go into trade that in the secondary market. A market maker is going to be like, oh, I don't have all these shares. Let me tap into the primary market and speak to the fund issuer and see if they can create more shares for me. So the market maker, who is also an authorized participant in most cases, and again, these are all names, and it'd be better if we had slides to show you the process flow, but just follow through this. Market maker goes to the issuer and says, I only had 20,000. These guys want to buy 100,000. Can I have 80,000 shares? And as the issuer, we'll say, sure, deliver us these securities at this amount, and we'll create new shares for you. So the market maker goes out and says, okay, I need to buy these securities, grab them, and then they transfer them into what they call an in-kind transaction. They say, hey, I got these, I think CNRG has 46 stocks. I got these 46 stocks. It was, equates to whatever 100,000 shares is. Say it's 3 million. Sends it on in to us. We're like, thank you. Here are your shares. They then now have these 80,000 extra shares. And they go, okay, people who wanted to buy this fund, here are 80,000 shares. And that happens about every little millisecond in the ETF industry. And that's the process flow. Someone on the secondary market is looking to buy an ETF. Market maker says, I have shares for you, but I need to go actually create some more to meet your full demand. Comes to the issuer. The issuer says, you need to give me securities. The issuer then gets the securities and returns them back. And that's how it goes. And it's the same process in reverse for redemption. I sell back my 100,000 shares of clean energy. That market maker doesn't want to hold that much. They then go to the issuer and say, hey, I'm destroying these shares. Sometimes that's what we refer to it. We're redeeming these shares. So they're like, okay, sure. State Street's like, well, you can redeem your shares. Give us your 80,000 shares. Here are the securities back. And now the market maker then goes about and sells those securities to other people, keeps them on their books. But that's the process flow of the infrastructure of ETFs that allow you then to tap into the secondary market liquidity of ETFs. But even if you can't meet that sort of liquidity out there, there's this whole primary market for ETFs that allow you to have implied liquidity and create portfolios in a very efficient manner.
Perfect. So when we start talking about, at a high level, how ETFs work, you mentioned, throwing out the term comparing to mutual funds. And I love that you threw that out there, because I think that's one of the common questions that we get. I think as we're talking with members, they're like, hey, I have mutual funds in, let's say, my retirement account. What's the difference between a mutual fund and an ETF? So I think what are the key aspects in your mind between the two?
So we'll start with the similarities. Both are funds, right? They both hold securities. The difference is one trades on an exchange intraday, like a stock would, and the other only trades at the end of day at NAV, or the net asset value at 4 o'clock in the afternoon. So if I'm sitting here and all of a sudden I see really positive vaccine news coming out from, say, Moderna, well, I can go buy SPY, our S&P 500 ETF, right away. Boom, I'm in the market and I get that gain through the rest of the day. Provided there is a gain and people respond to the vaccine news, I hope they would, considering what happened on Monday. In a mutual fund, I'm like, oh, I got to get into the market. Well, I got to wait all the way till 4 o'clock when everything else has happened. And that's the biggest difference there's also other structural differences from a taxation perspective, which I can speak to, but that's the biggest difference is they're both funds, but one trades on an exchange, one doesn't. You can basically trade between 9:30 and 4 for ETFs. You can only trade at one time on a mutual fund. And then from a tax perspective, because if I go back to that structural difference or that structural process flow, We're delivering securities out in kind. So it's a redemption. So it's a non-taxable event. So if a lot of people want to redeem from our funds, the existing shareholders are not left with a capital event, with incurring all these gains for selling all these securities that maybe have rallied over the last 20 years. Conversely, on a mutual fund, if I want to redeem, I don't have this, but say I want to redeem $10 million in a S&P 500 mutual fund, that portfolio manager has to go and raise cash to meet that redemption. When raising that cash, you're hitting the market, and you actually create a capital event and create a capital gain for the shareholders that are still in the fund. The person who left, the $10 million who left, they're out. They don't have to pay any of those gains on the securities. And that's another big difference in terms of the structural underpinnings. And that's why last year, the U.S. large cap blend mutual funds, 90% of them paid capital gains. Only, I think, 3% of ETFs paid capital gains. So that secondary market, that transaction, the in-kind redemption process, all creates efficiencies and costs, and really cost efficiencies too for the end investor. And those are some of the key differences.
Perfect. So the frequency and the ability to trade, and then on the tax side of things, I guess, can you hit on the cost side of things? But I think this is probably the third key area that we see, and when we go through the differences between mutual funds and ETFs, at a high level, can you hit on those differences?
Yeah, I mean, many ETFs are index-based strategies, and the costs of those are much lower. I think the average fee for an ETF is somewhere in the neighborhood of 30 to 40 basis points, because there are some real thematic ETFs that are in the 70 basis point range. We have some that are in 45 basis points, definitely not as high as 70. But we also have a lot of our strategy. We have an entire low-cost portfolio suite, and some of those carry just 3 basis points. So if you have $10,000 invested, you're basically just paying $3. So really cost efficient. Now, conversely, on a mutual fund side, a lot of these are active strategies that largely are charging fees of upwards of 100 basis points. I think the average U.S. large cap manager is around that 100 basis point mark, 1%, I would say. Ours are 0.03% in some cases. So there's a vast difference of costs, and some of it goes to the type of strategy. But I would argue too, in an active environment, a lot of active mutual fund managers, particularly in the U.S. large cap space, have had a really hard time outperforming their benchmark. So when you add it all up, you have high fees, the high probability of capital gains, and you maybe have a high probability of underperforming the benchmark. And that's really not a positive client experience. And that's one of the reasons why we've seen some strong inflows into the ETF industry just this year, or I think it was Monday. The U.S. listed ETF industry hit over $5 trillion in assets. And State Street ETFs in the month of November, we've taken more than 50% of the flows into ETFs. And it's a result of the election, the positive vaccine news on Monday, where investors utilized our ETFs to get into the market quickly to express those tactical views. But again, it's not just all tactical. There's a lot of strategic holdings too.
Yeah, and I think, from a financial planning perspective, I think those are some of the most overlooked aspects when it comes to people investing, whether it be through live streams like this or in one-on-one conversations. People ask us, what's the market going to do in the short term? What stock should I invest in? All these types of things that, quite frankly, no one has control of, when the things that people can control, such as taxes and fees, often have huge impacts. And, for perspective, people look at these expenses, like even 1%, or we throw around like 100 basis points. It sounds really, really small. But if you add that up over 30, 40, 50 years, it can eat up, 20, 30, 40% of the portfolio down the road due to, higher expenses. So I think that's an important aspect to stress that may get kind of glossed over when it comes to investing, because it's not the sexiest or the most fun thing in the world. Cool. So far we talked about how ETFs work, benefits, how they compare. I guess flipping the script a little bit, what are some of the downsides or some of the challenges when it comes to ETFs and when people adopt them in their portfolios?
Yeah, so I get paid by the ETF, so it's hard for me to talk about downsides, but I will. I think one of the downsides is there's been a lot of products coming into the space. And that's not necessarily bad, but it can be in terms of understanding what type of strategy is right for you and doing the appropriate due diligence. My team, I run a broader research team, and all we do every day is provide data and analytics for clients so they can make better informed decisions. We run nearly, I think, 10,000 service requests for clients so they can understand what's in the funds, how they may have performed, and how they perform relative to other strategies. So one of the, and this isn't indiscriminate to just ETFs, mutual funds, there's a lot more. But I think, the more and more that come out, the more is there a need for due diligence. I also think as a result of that, liquidity can be sometimes, for smaller products, less of an understood topic. So, some of our more liquid products, like a SPY trades, $25, $30 billion a day. That's liquidity there is not a problem. But for brand newly launched funds that come into the marketplace, they may only trade, say, 100 shares a day. But yet the underlying market is actually quite liquid, right? So again, I go back to our example. I want to buy 5,000 shares of something that only trades 100. Market maker can tap that primary market and give me my shares in a liquid manner. But it requires a little bit more effort to understand how you trade, what's your execution strategy, and when you should be trading. So not one of the things I always say about best practices of ETF trading is not in the market open, that first 30 minutes, not at the market close in the last 30 minutes, because those tend to be the more volatile periods, and definitely do not use market orders. You should really be using limit orders to control more of your price. So in terms of downsides, it's about understanding the full ecosystem and tapping into the resources and insights that an ETF provider such as ourselves has to offer so you can make better informed decisions.
Perfect. And just a quick reminder for anyone who's just started tuning in since we started, if you have questions, toss them in the comments. We'll kind of sprinkle them in throughout and at the end. One question I'll toss in here before we move on to the next area we're planning on talking about. You mentioned performance aspects of it, and one question that we often get, and I'm glad this has been asked, the difference between mutual funds and ETFs. A lot of times the general thought was, okay, in a down market, that's essentially what you'd be paying the higher fees for an ETF or the active management. And kind of the same thing was talked about with robo-advisors or automated investing. Like, okay, they're not going to handle down markets well. Can you kind of hit on the historical performance between high-level indices and ETFs and mutual funds? And again, I guess past performance doesn't predict future performance, but historical can add some context here.
Yeah. So even just this is a weird year. That's sort of an understatement. But the market fell by over 30%, and we've obviously rallied. The S&P 500 is I think up close to 9% now, depending on what's happening today. Active strategies this year, the U.S. large cap active strategies, only about 49% have outperformed their benchmark. So if you consider this a down year, which even though we're positive, I do consider this a down year just because of the sizable volatility we've seen. So from that perspective, we just use this year. It doesn't really showcase that there's a propensity for active managers to justify their fee for mitigating severe drawdowns. And I would say, generally we only have a bear market once every 10 years. So you're really paying 1% to an active manager just for something that happens once every 10 years. And we've done a limited study on this, and I say limited only because we haven't written a paper on it yet, is, when you look at the trends in active manager performance on like a rolling 6-month basis, so every 6 months, relative to what the S&P 500 is doing. So if the S&P 500 is going down, what's the correlation to active managers' percentage of outperforming? There's really not a strong connection. There's a lot of other factors going on. So I wouldn't really hang your hat on using an active manager for being able to mitigate massive drawdowns, because again, they only happen once every 10 years. Now we have a lot of idiosyncratic one-off shocks of volatility in this market environment. We've seen those. But, again, those are maybe only happening over, say, a a 4-week time span. So again, you're only doing something that happens in a 4-week time span. So I don't really believe that investors should be using active managers to protect on the downside. I think they should use it if they feel that active managers or active strategies are rewarded in a certain market. And I think there are some, like in core fixed income. We've seen active managers do quite well there over long track records, over different type of market regimes. Also in international markets in the equity space too. And that's sort of on an average, right? There's going to be some active managers that underperform. That again goes back to due diligence, but I would not use active managers just because I think they can protect on the downside, because I don't see that being the case.
Perfect. I appreciate the insights on there. And I think, another thing when we look at ETFs, a lot of times we hear of, stock or equity ETFs, because I think that's kind of front and center and kind of comes across the face. But, can you hit on the different types of ETFs that are out there? Because I know there's a ton of different options, and I think it'd be good for people to understand what those options are.
Yeah, so there's about 2,000 ETFs, and there's a lot of different varieties. There's just starting at the top level. There's equity ETFs, fixed income ETFs, commodity ETFs, specialty ETFs, which are things focused on like currencies, alternative ETFs that are like managed futures. And then if you take a step below that, particularly in commodity ETFs, we have one with GLD where it holds physical gold. And so when we go back to that market maker AP example, if you're buying shares of GLD, go to the secondary market, you try to buy some shares, there's not enough supply. They go to the authorized participant, and they actually, there's actually a shipment of gold that is delivered to a vault over in London. So, that's a really interesting concept, and it's been around since 2004. And because of what's happened this year, we've seen significant flows into our gold suite overall. But even within fixed income, it's not just broad corporate bonds. You can slice and dice the investment grade corporate bond market by maturity. So only investing in the 1 to 5 year maturity, or say the 10 plus. Similarly, you can buy high yield bonds, emerging market bonds. You can buy inflation protected. There's so many different varieties. And then there's active ETFs with all of this. And we have a handful of active ETFs, one focused on bank loans, which are a form of below investment grade credit. And then in the equity ETF space, you have your plain vanilla S&P 500 or international equity markets, or mid caps, the NASDAQ. But then beneath that, particularly, you have sectors. So you want to just invest in the tech sector, you can do that. But then we even carve it up a bit more. We break it out by theme. So we have a whole suite of thematic ETFs, like I mentioned earlier with clean energy, but we also have something like smart transportation, intelligent infrastructure, and then one, which is my favorite, which is, is relatively new, but final frontiers, one of investing companies, in innovating within space. So there's so many different ETFs out there. And, at the top level, you have, yes, equity and fixed income and commodity, but beneath the surface, there's a lot of differences, and it requires, some due diligence and really relying on some of the insights and resources that a provider has, as well as the data points that we can share with you.
So with all these different options, it sounds like I could have a simpler way to ask would be like, okay, what types of ETFs aren't there, rather than what types of ETFs are there? But how can people evaluate ETFs and look at them and say, okay, how does this align with my overall strategy? What are some insights you have on that front?
Well, I would come to our website, so ssga.com/ETFs. We have a tool on there that allows you, it's from Morningstar. It allows you to compare and contrast up to 5 ETFs at once, as well as mutual funds. And it shows you what they've done historically, what the holdings are. Are they mainly mid caps or small caps? What's the region? Is it mainly US or international? And then I would just leverage our website too. We disclose, ETFs, they disclose their holdings daily. So we disclose our holdings, the important characteristics, like what's the dividend yield of the underlying constituents? What's the yield of the underlying constituents on a fixed income strategy? So I'd really sort of, from my perspective and our firm's resources, I'd leverage those that are free to any investor out there to sort of, break through all the different noise in the ETF space, I think that'd be very helpful.
Perfect. And kind of like at a high level, it's like, hey, number one, should I be investing, or is there a better use of my money? Number two, it's like, hey, what goals am I focusing on? What's my time horizon? How much risk am I comfortable with? Kind of figure out high level split between, equity and fixed income. And then the third step there with what you're talking about, like, okay, what vehicles did I actually use to implement that strategy? And that's where, awesome stuff like the tools you mentioned come into place. I think that's extremely helpful. So I guess we got time for a couple more questions. One thing I'd like to hit on, and you mentioned it a little bit, briefly throughout some of the responses, passive versus active. I guess the historical view of ETFs was ETFs are passive and mutual funds are active, and I know that's not the case. Can you hit on kind of how that works in an ETF world, the difference between a passive ETF and an active ETF, why it matters, and how that can kind of impact investors?
Yeah, so many ETFs are index based. So they follow a set of rules that are managed, some would say passively. We always say that investing is never passive. Even if you're following just an index, you have to control for rebalancing and liquidity and what have you. But they follow a set prescribed of rules, and they are viewed as passive instruments. Typically, they are more lower cost. Now, active strategies, there's more investment manager discretion. Just because an index rebalance says to buy, a technology stock, an active manager following their own set of rules, they don't have to buy that stock. They don't have to follow what is prescribed in their prospectus in terms of what securities to buy or sell based on a list provided by an index provider. That's kind of the main difference. But I would always say that, ETFs are active instruments. They are used actively. We see our sector ETFs and our industry and thematic ETFs used in a very active manner to play market trends, whether it's the rise in interest rates or spot price in oil. So even though they may be managed following a set prescribed rules and viewed as passive, as I said earlier, investing is never passive, and there's a lot of investors being active with these passive instruments.
That's interesting. I like that word. Okay, that the instrument itself may be passive, but people can be active with it. I guess one thing you hit on earlier too is, I think you said $5 trillion in ETFs. I guess where do you see the biggest uptick in usage and in that overall trend of overall flows into ETFs?
Yeah, so fixed income ETFs are going to be big, plain and simple. This year, they've already beaten their prior annual yearly record for inflows, which I believe was 155 billion. And right now, we're at about 179 billion. And I actually think that number probably is a bit low. I haven't looked at it in the last day or so. But we're going to hit that $200 billion mark for the industry, fixed income ETFs. It's over 1 trillion in assets now in fixed income ETFs. They've grown their asset base by roughly 25% this year alone. And as more investors come to the ETF marketplace, they're going to be utilizing it throughout their portfolios. And I've always, believed, and we actually put out a prediction of where fixed income ETFs could go based on a model we built. It's a blog that's out on our website. We basically said 1.7 trillion by the end of 2022. And I think we're a pretty good shot at hitting that. But it came down to 4 reasons. It was, cost. Fixed income ETFs, as well as broader ETFs, are just inherently lower cost than fixed income mutual funds. From choice, you have a lot more choice from a fixed income perspective. You can break apart the entire core bond market. You can buy high yield, emerging market debt. You can buy active. But there's more comfort in the structure too. That's a third C. The comfort is around looking at identifiable periods of volatility we saw in March and seeing that the fixed income ETF withstood the market duress and was being utilized as a liquidity tool by many investors. And then the last is client types. We are an aging demographic base that are going to need more income solutions. In an environment where, the broad core bonds are yielding about 1.2%. There's a strong connection between the yield you buy today as well to the subsequent 3-year return that you get from that. And 1.2% is not going to cut it. Now, if you're an active manager charging 40 basis points, 50 basis points to provide maybe a yield just a bit above that, because you're going to buy some junkier credits, well, that's a pretty high hurdle rate to jump over, and you're not really left with much. So I think investors were going to go to fixed income ETFs where the fees are much lower, so that hurdle rate is much lower, and actually then use the broad choice to create customized portfolios. I just wrote a blog about this out on our website right now, about how you can try to find income amidst a sea of low rates. And fixed income ETFs, I think, are going to be one of the reasons, or one of the ways that investors try to, and going to continue to accelerate the growth in that industry.
Perfect. So for a financial planning nerd like me, I have a new to-do list on my reading list for things I got to read, because that sounds exciting. So I guess, we're through the questions and everything. Any closing thoughts or ideas for the audience?
No, I would say thank you. And, ETFs are, they've been around since 1993, but the industry continues to mature. We continue to see more inflows going to ETFs than into mutual funds. And there still is a decent amount of investor education that's required to go into the ETF space. Understanding the differences in the structures I laid out earlier, it's very different to what people are very used to in the mutual fund. I mean, that's been around for, 100 years. We've only been around for 27 years now. And with that, there's a lot of products out there with seemingly similar names. And I think that requires extra level of due diligence. That's not different in the mutual fund space. There's a lot of things called the same there, but in something that is, growing in adoption, investor education, due diligence is really important. And as the ETF authority who launched the first ETF in the US, we stand ready to provide all those answers in a very data-driven approach, so you can make the best decision for your own personal risk tolerance and investments.
Perfect. I appreciate you joining and echo the thoughts on research and making data-driven decisions. So, feel free to check out different resources, including SoFi. Reminder, you can also schedule an appointment with a financial planner at SoFi. Everyone, hopefully you have a great rest of the week, great weekend, and we'll be back next Thursday at the same time. Thanks.
Thank you.